It's great to be back in Minneapolis. I haven't been here in a number of years, and to be here with my good friend Neil Kashkari. We went through the heat of the crisis together. As said, I was at the Federal Reserve Board from 2006 to 2009 and chairing the Supervision and Regulation Committee, and so obviously worked very closely with Neil as we were dealing with both formulating the ideas that became the Emergency Economic Stabilization Act, more popularly or less popularly known as the TARP, and as well as then in the implementation of that. So it's something that at the time we understood that we were going to need to have very important financial regulatory reforms. We needed to prevent the system from totally melting down, but we also knew that the system couldn't stay as it was from before. And so I'm really delighted that Neil has now coming to the Minneapolis Fed, has focused on this issue, and particularly delighted that he's asked me to participate in this excellent forum. And what I want to mention to Neil is that words become very important when you're at the Federal Reserve. People pay a lot of attention to them, and that's one of the good things about this conference, that people will be focusing on these issues. I want to give one example of sort of the difference between being an academic and being at the Federal Reserve. Some of you may have heard this story before. So before I became a Fed governor, I had agreed to chair a panel on hedge funds and risks associated with hedge funds. This was back in 2006 at the Atlanta Fed. Then I went from being Professor Kroszner to becoming Governor Kroszner. And then when that was going to be my first public appearance, because the press was involved in that conference, looking at financial risks, and as I said, focusing, and my particular panel was on risks at hedge funds. And so of course they wanted to know what I was going to say about monetary policy. So the only numbers that I'm going to say are 3 minutes left, 2 minutes left, 1 minute left, and nothing more than that. So they go back to their laptops and sort of shoot out the headline. And as you know, if you've looked at some of these screens where there's no story behind it, where it's just a headline to come across in capital letters, it was Federal Reserve Governor Kroszner says nothing about monetary policy. But that doesn't all fit on the first line. And if you've seen these, what happened is that a number of them, it just said, Federal Reserve Governor Kroszner says nothing. Got lots of congratulations from my friends and former students in the market. Said, Randy, you really made a mark. Your first time out of the box, they reported that you said nothing. Really impressive. And obviously, if every time an academic said nothing, that had to be reported, that's all that would be in the screens. So words matter a lot, and how we think about these very important issues before us are very, very important. And so I very much share the goals that Neil put out in his speech, focusing on really trying to, as much as possible, eliminate the key fragilities in the system to protect the taxpayer and to try to make the financial system of the U.S. do what it's supposed to do, which is support sustainable, solid economic growth, and also to try to minimize the chance for government action. And the title of my remarks focus on cost benefit. Obviously, many of the speakers earlier today focused on cost benefit, so I apologize that I may be touching on a few things that have already been touched on. I'm going to try to minimize that overlap, but I was delighted to hear that because I think that's crucial. And that was something that Neil mentioned in his speech, the importance of bringing cost benefit analysis to bear on these particular issues. Because a lot of speechifying has been done about how we need to do this, we need to do that. But what we need to do is think about what we need to do. That is, we need to do basic cost-benefit analysis. And so I think to make good policy, you have sort of a five-step process. One, you've got to diagnose the problem. And this is actually one of the things that we were talking about earlier today, thinking about where are the externalities. So if there's an institution that gets into trouble, why does it affect other things? Because obviously many of the industries in the U.S. are extremely important. Agriculture, obviously we're looking here, the grain-belt beer, obviously is a very important industry. I see that across here. But telecom, public utilities, incredibly important. But we don't have the same kind of crises that are associated with them. So we have to kind of understand that and understand, well, what are the sources of that? And then think about trade-offs. Well, why do we are we willing to put up with a little bit more fragility in this area to get something out of it, or do we not get anything out of this at all, and so we should just try to minimize those fragilities? So you've got to do that, and some of the discussion was already, Chari and Jim Bullard also mentioned some of these things. You've got to have some theory of what's driving these externalities. To be able to diagnose the problem, certainly need to look at what's going on, but you also need a filter through which to see the data, and so some theory is very important in that. And obviously people have different views of what generated the crisis, where the fragilities are, but that's one of the important things that you guys can do. Uh-oh. I guess maybe it's not that important to do that. I apologize. No theory at all. We'll take all the theory back. None of that. All right, because I also get electric shocks when that happens. So it's just empirical, all right? Just empirical. You need to act. You can't just say, well, maybe in 10 years we'll have the analyses done. I mean, that was something that certainly I saw very much during the financial crisis. If we didn't act quickly, even though we may not have had all the information we wanted, and we would have loved to have more of analysis, the markets would have acted for us, others would have acted for us. And so you need to act. And so obviously we passed something like the Dodd-Frank Act. But I think something that should be a very important part of any regulatory change, and we didn't explicitly do this in Dodd-Frank, although to some extent we did, is what you want to do is you want to gather data and then at some point have an explicit assessment of, well, how are we doing? Did we achieve the goals that we wanted to get to? Were there unintended consequences? We've just had the 5th anniversary of Dodd-Frank. This seems like a particularly opportune time to be sort of stepping back and saying, okay, there are a lot of different parts of Dodd-Frank. Some of them may be working well, some of them may not be working well. There may be things that we want to tweak. There may be other things that we don't want to change. But doing that, reflecting on it, that I think is extremely important. Some people have taken a more extreme version of this approach and said all regulation should sunset after 5 years, and then if people feel that they're worthwhile, then they can be revived. I think that creates far too much uncertainty. You can't just eliminate the entire regulatory system for a whole area, whether it's a nuclear power or financial regulation, every 5 years. But you can have a serious systematic analysis that perhaps a blue ribbon panel of academics, regulators, others would do, or the GAO or others, but you need to have the data, and so that's something that's very important to do. The Office of Financial Research is trying to gather some of that. The regulators are trying to do some of that, and I think that's a very important step forward. But I think it would be valuable to have that as part of any regulatory change, that it's explicit. It's not that, because now the OFR, the Office of Financial Research, is trying to get some of this data and see what ability they have to get it. It should be part of the legislation. We're doing something new here, so part of it should be gathering data in a way that is then easy to analyze to try to address whether this is being effective at getting at the causes, getting at those the diagnosis that we set out in the first step. So diagnose the problem, and theory is going to be helpful there. Propose alternative policies, and obviously that's some of the discussions today. Best as possible cost-benefit analysis, which is what the Minneapolis Fed, I believe, is going to be doing through the rest of the year, try to look at these different proposals. Obviously, we did act, but I think doing an assessment of that is very, very valuable. So now what I want to do is give you a little bit of my perspective and what I see some of the key fragilities sort of from where I sat, both sort of with one foot in academia and one foot in the midst of the financial crisis, being at the Fed from 2006 to 2009. Because what I want to use these as sort of touchstones, at least for me, whenever I'm thinking about any regulatory change, I always come back to these three issues. How well do they address these three key fragilities? And one of those is leverage. Obviously, that was a focus of the discussion this morning. But it's leverage not only at financial institutions, but also more broadly in the economy. And I think one of the things that hasn't gotten as much attention in Neil's speech is, he talked about the potential for high capital to make banks into close to public utilities and be very unlikely to fail. Talked about the potential to break them up, but also, just as important, said, well, maybe we should think about getting rid of subsidies to leverage in the system, not just in the financial, not narrowly just in banks, but also throughout the system. And so I think that's something that's very important. We touched on this a little bit earlier in the discussions, in particular in the housing market, that it wasn't just the commercial banks, but also the government-sponsored enterprises and many what may have been very well-meaning very well-meaning regulations or policies that were trying to promote home ownership. But of course, no one likes to actually pay for anything. So if you can push it off balance sheet and you can get these government-sponsored enterprises to do something for free, provide these guarantees, everyone's better off, right? Because there was no on-budget thing, no politician said this was going to cost more, and more people were getting into homes. Well, that's fine until you realize that, exactly as Debbie was saying, there are implicit guarantees that are there, there are implicit subsidies that are there, and so we want to think about those kind of leverage issues. I'll come back to that. I'll come back to that later. Second is liquidity. And this is an issue that came up in the debate and the discussions at the end about, well, what's some of the causes of the crisis. I think both leverage and liquidity, so leverage that is not enough capital to take the shocks, as well as liquidity, that there's a mismatch in the assets and liability structures in financial services firms that tends to be more extreme than it is in other firms, is something that you can either consider a cost or a benefit. So one of the things that the financial sector does is it does maturity transformation. That is, you can take your money to the bank, you have a very liquid liability of the bank, or your asset, but the bank's liability, and you get to participate in a pool of loans. Otherwise, you wouldn't be able to get that. You wouldn't have that kind of diversification. But those loans tend to be longer lived, so they're going to be not immediately callable, but they might be 30-year mortgages, or they might be loans to commercial and industrial enterprises. So the positive of that is that that's a transformation. Financing is lower. Financing costs are lower than it otherwise would be for entrepreneurs, for homeowners. The negative of that is there's a mismatch. So people can pull their money out, but the bank has these longer-lived assets that may be very difficult to liquidate quickly. And so that's one of the key things you want to think about is those kinds of trade-offs. There's a benefit in some of the credit creation and some of the other positives that banks do, but also a cost. So you want to think about those two pieces. Liquidity, leverage, crucial pieces. Third, and I think the piece that has gotten much less focus because it's a more difficult to explain and really gets into kind of the plumbing of the system quickly. And if you've ever done home renovations, you know that what you want is just the plumbing to work and not have to worry about how the plumbing works. But unfortunately, you really need to know how the plumbing works, because it's the interconnections that are extraordinarily important. And I think that's crucial in thinking about any types of reforms. Well, some of these reforms may address one or two of those problems, or maybe both of those problems, but if they have an unintended consequence of increasing interconnections or increasing fragile interconnections, that can be problematic. And so once again, you have positives and negatives of things that create interconnections. So securitization, in principle, is a good thing to get local risks off of a bank's balance sheet and to allow people to participate in a nationwide housing market. Before the financial crisis, the mortgage market was by far the largest market. It was even larger than the U.S. Treasury market. And so any internationally diversified investor would have wanted to participate in that. Very, very sensible, and participated in a diversified way. The challenge was that although that addressed one problem, it also created an interconnectedness problem, because one of the things that occurred is now a lot of the different financing markets were linked to each other. So when you used to have this very balkanized system in the U.S. where you had Texas banks and Minneapolis banks and California banks, that had downsides, and I'm going to talk a little bit more about those. But one of the positives about being able to set up a mortgage-backed security is that you got a loan in Texas. So if there's an oil boom in Texas, great for Texas, but terrible for California, where people are driving a lot and don't want to pay all that extra money for their gas. So something that's good for Texas was not so good for California. Value of diversification. But the innovation of securitization and then subsidies to that through the GSEs, so this developed very, very rapidly, that changed the underlying correlations. So we were using data that looked at the post-war period. So we had 50 or 60 years worth of data to show that there was no nationwide downturn in housing. And so that was something that was quite strong. But that data was not relevant for thinking about the new world of securitization, because you have now broken down those barriers. The benefits from the diversification were not as strong as they once were. And so you need to think about those things. You need to take that into account. That doesn't mean securitization is bad. It just means that when you're doing the risk analysis of it, you have to understand that the innovation will change the underlying correlations. That was one of the things that we had missed, and I think one of the things that's very important. Also, when you're thinking about changes to leverage, changes to liquidity, you have to think about it in the context of the other interconnections. In a very fragile world, so you want to have a lot of capital at banks. In a world in which there are far fewer interconnections, well, the externality is going to be lower, and so maybe you might make different trade-offs there. So you have to think about these things not in isolation, but connected with each other. So quickly, what I want to do is mention, have we made progress on these? And I think we've made some progress. Are we in the perfect state? By no means. Some of the numbers were already mentioned by Till about dramatic increases in the amount of capital. Lael Brainerd, Governor Brainerd has recently mentioned that more than $500 billion in common equity has come in since 2008, more than $800 billion in high-quality liquid assets than in 2011. And so we've made progress there. I think more questions on whether we've made as much progress on the interconnections and the market infrastructure. And what we want to do in thinking in terms of cost benefit is, well, what is sufficient, and then what are the trade-offs that are there? So stepping back in a very big picture, you want to make sure that there's enough credit flow to support growth, but you don't want to have so much credit flow that you have lots of variation that can destroy growth. And so what we really want is the elected officials to give guidance on that, to make that sort of social choice of, are we protecting against the 30-year flood, the 50-year flood, the 100-year flood? That I don't think should be just left up to the regulators and supervisors. I think that's a public choice that needs to come from the elected officials. They haven't really done that. Dodd-Frank kind of said, well, take care of this, take care of that, but didn't really give enough guidance to say, well, what are the appropriate trade-offs? Because certainly as you if you have more and more capital in the system and make banks closer to public utilities, you get one of two things that will happen. Credit creation will become a little bit slower. That might be a positive thing. You might prefer that rather than have the variation. But it will be costlier at some point. And you also may get pushing things off into the shadows. Because as you keep focusing on one particular instrument, let's say capital, and make that higher and higher, you're giving more and more incentives to get around that one particular instrument. And so you want to think about those kind of trade-offs, and you want to think more broadly about, well, what are the benefits of the financial system? Well, they can provide credit to entrepreneurs and funding for growth, and so there could be a trade-off there. Perfectly legitimate. It's not to say that there isn't, because certainly you can maximize growth in the short run by having a credit boom. No doubt about that. But that's not what you want. That's not what the goal of this is. But I think there needs to be more guidance, and I think one of the things that would be really great for Minneapolis to do is sort of try to set out those parameters. We're not going to be able to calibrate this perfectly to be able to tell you 2% more capital gives you 0.2% less probability of crisis and da-da-da-da. But that kind of framework and thinking about it in that way, I think, is very helpful and would be very valuable. And also, I think one of the analogies that I use in thinking about capital and the focus that capital has gotten, it's crucially important that we have much more capital than we had from before. And the question is, what is enough capital? Some people kind of argue that, well, when we can't deal with this problem, we can't deal with that problem, let's just have more capital, because then it'll make them impossible to fail. Well, I think unless you have 100% capital, it's not going to make them impossible to fail. And there's some, I think, problems that can come with that. One, as I said, maybe a growth trade-off. Two, you can push things off into the shadows. But three, you can get a false sense of confidence that and supervisors and investors also, because it's not just the supervisors, but also investors, can take their eye off the risks. And I sometimes use the analogy of the Maginot Line. Because there was a very big debate in France after World War I about between de Gaulle and Maginot. De Gaulle wanted to use a whole variety of instruments to try to keep the Germans at bay, invest a lot in new mechanized transport and airplanes, all sorts of things like that. Maginot said, no, what we need is the line. We build this fortification, and the Germans won't bother us again. And so Maginot obviously won. And what's quite amazing is that, because I've looked into this a little bit, if you visit France, a lot of the Maginot Line is still there.
So he was dead right. That thing is going to stay and is going to protect, is going to take a lot of abuse. The Germans wouldn't be able to get through it. But what did it do? It created incentives for the Germans to get around it. They found the weakness in the weak link, which was the Ardennes forest. Well, people thought, well, that's much too dense. Nothing, they could never get through quickly there. Well, the Germans innovated the Panzer, this very fast tank, very mobile to get through there. They also innovated process, the Blitzkrieg, and in 2 weeks, France falls to the Germans, even though the Maginot Line is still there. And so I worry very much about focusing too much on any one instrument, that it gives very strong incentives to get around. And so if you think that there were incentives to get around some of the regulations pre-crisis, if you move capital to these very high levels, the incentives are going to get even higher. That's not to say that we shouldn't have high capital. It's just to say that if we want the most stable system, we don't want to focus too much on any one instrument. Actually, there's a paper that's just come out a few days ago from the IMF that I recommend very highly. The title of it is Costs and Benefits of Bank Capital Regulation. So they seriously try to do an analysis. It's a first step, not final. Their analysis is that on the order of 15 to 23% seems to be the optimal level. That's just a first pass, but at least they're trying to get at that. Second proposal that we'll be talking about is focusing on the breaking up the banks. And Simon's going to be talking about that, and we'll have a lot of discussion of that. But I want to come back to, in thinking about that kind of proposal, thinking about this interconnectedness issue and the correlation issue. We don't want to inadvertently create a correlation problem and think we've actually solved the problem. Because the analogy that I want to use is a historical one. We actually broke banks once before. We had very strict geographic restrictions on bank expansion. So when we got into 1929, we had 25,000 banks in the US. When the banks were reopened in 1933, we had 15,000 banks that were left. See more logical innovations coming in. So we went from 25,000 banks, so no large banks in the US, to 15,000 banks. And there was a correlated asset risk. So by having a lot of banks did not prevent us from having a major financial crisis, from having credit crunch, from high unemployment, et cetera, et cetera. So you have to be careful about that because they were correlated with each other. Why were they correlated? Because there was a so-called correspondent banking system. Even though the banks were very much broken up into individual pieces, they still are going to interact with each other. And so you had these correspondent relationship with the major banks and cities. So if there's a problem with one of the major banks and city, you had a problem throughout the entire system. And so that's just, today we call that regulatory arbitrage, trying to get around the regulations, but it's just a natural part of the system. There's always going to be an attempt to try to diversify some of the risks. And so either you can do that, like securitization was one example. There can be good aspects, there can be bad aspects. But simply breaking up the institutions doesn't necessarily solve this correlation, this interconnection problem. Same thing with the money market mutual funds in the more recent time. And Neil and I were certainly dealing with those challenges in September of 2008. It had nothing to do with concentration of assets in one particular fund or a small number of funds. Actually, the fund that got into trouble was a relatively small fund, but it raised questions about the entire asset class, and there was effectively a run on that asset class. And so that was the issue. It had nothing to do with large or small institutions. They were correlated with each other. I think a number of things have been done and to try to address some of those things in money market mutual funds, and we'll be seeing whether we need to do more or not. Another example is Canada. So Canada got through the Great Depression with no trouble. Canada has effectively just 5 large banks. So they've had a very large, very concentrated banking, or I shouldn't say very large, well actually large, the assets in the largest banks are larger relative to GDP and as a whole larger relative to GDP than in the US. So you've had a very concentrated system, you've had, but a system that was very stable. Because what they had is a nationwide branching system. So problems in one area could be integrated in. If they're doing well in one area, they're not doing as well in the other. All integrated into these large banks. And so the amount of assets that are in the top 5 banks in Canada is 85%. In the U.S., it's about 50%. And so Certainly you can find examples of the contrary. A lot of concentration in the UK, they got into trouble. So I don't want to say that concentration is the answer to financial stability. I'm not saying that at all. But when we're doing a cost-benefit analysis, we don't want to jump to the conclusion. We want to look at other countries, look at their experiences, both historically and obviously in Canada more recently, where they didn't have the same extent of the problems that we had. Say, well, maybe looking at the underlying correlations is the key thing rather than looking at the size of the institutions. So to conclude, what we want is good explicit cost-benefit analysis, and that is going to require both theory and data in order to be able to do this. And I think it's good for policy, but I think it's also good for the policymakers. The MetLife decision that just came down recently is challenging whether sensible cost-benefit analysis is done. I think making that more explicit will help to protect the supervisors and regulators in what they're doing and be able to explain what they're doing. Always go back to the touchstones, at least for me: liquidity, leverage, and interconnections. The OFR at the Treasury is trying to start this process, but it's still early on in the process. Don't rely too much on any one instruments, because you can get the Maginot Line, and you can get very strong incentives to get around that, and you can get a false sense of confidence. You don't want that. You also want to really focus on interconnections, and so look at the correlations of the underlying risks. Look at what will happen if you do have an alternative structure, and will it really deal with the problem that you want to get at. And then more broadly, I think an area that really needs a lot more work is this broader issue that Neil had raised about leverage throughout the system, whether it's in the GSEs that effectively subsidized leverage, and we have done nothing to reform them. They're in government conservatorship back when we were in government, and they're still in government conservatorship. They're still enormous in this market. It is perfectly fine if the policymakers wish to provide support for affordable housing. There's nothing wrong with that. But that should be debated and put on balance sheet, and that should be something that is explicit rather than implicit. And so I think this effort that Neil and Minneapolis Fed are doing is incredibly valuable. I think thinking about these alternative approaches, doing cost-benefit analysis, will be extremely valuable. Looking at history, looking at international will be very, very helpful. And I very much look forward to the proposals that Neil and company are going to come up with at the end of the year. Thanks so much.
Randy, a lot of your comments were focused on preventing crisis from causing failures, causing a widespread downturn. How about once we get into a crisis? Once we're already there, as we experienced in 2008, a lot of work is being done on the resolution authorities and things like TLAC. Could you give your thoughts on, once you're in the middle of a crisis, how you think these tools are going to work?
Sure. Well, obviously these are new tools, so it's going to be hard to know exactly how they will work. I think one of the things that we saw during the financial crisis is when you have a lot of uncertainty about how contracts are going to be enforced, people run from those contracts. And so one of the most important things is to just provide a lot of clarity about how orderly resolution authority is going to work. I think the FDIC and others have started to put flesh on the bones, but it's still very early on. Now, I can understand why the authorities don't want to be too detailed, because we're never going to know exactly what happens in a crisis, and so there's always going to be something new that will come up. So they don't want to tie their hands too much, but they have to tie their hands enough to have some sort of feeling for, well, how will priority be dealt with in a financial crisis? Will that be preserved or not? Because that will affect whether people will invest in those contracts in the first place, or if they fear that something is going to happen, they might pull out, and so you have an unintended consequence of making things worse rather than better at that time. TLAC, once again, this is something that is territory where we haven't had that much experience before, and I also think it's very important to have clarity on how that is going to work. We saw most recently during January and February some of the challenges in interpretation of how these rules will work with respect to payment of interest on certain types of securities, these contingent convertible securities that will be part of the so-called TLAC, the bail-inable debt. There were concerns that a large German institution wouldn't be able to make those payments. And rather than calming the markets that, well, gee, that just means that all this debt will be converted to equity and suddenly make these institutions better capitalized, it created a lot of uncertainty. And I think that came from the caused a lot of tumult in the markets, and a lot of that came from the uncertainty about how these contracts will operate. Now, of course, since they're new, there's not going to be the case law, there's not going to be everything around them, but going through exercises, I think, a little bit like the stress tests, and have that work through to see how that's going to operate would be incredibly valuable. Because then we'll get a better feeling for whether we have made progress or not, and also then we don't have as much of the unintended consequences during the crisis. We're generating uncertainty where we don't want to be. Now,
so on one hand, you say that we don't have experience with this when we actually do have experience with this. We saw precisely what we're seeing now with the cocos, that that would not absorb losses, so it starts behaving like equity, on the downside. Now, cocos of Deutsche Bank were promising 6%. I don't know who in Europe can get 6% without risk, so there's going to have to be a risk. So, well, it's going to go down when there's a risk. So what's the problem? In other words, we understand all of those things. The question is, why are we trusting cocos relative to alternatives? We've been there, so it's not like we need to try out these TLACs. That would take a failure of a major bank. So I'm not particularly looking forward to that. I don't think you and Neil have President Kashkari have good memories of that time. So so to try it out, I don't think we need that. Now about the shadows. As I said at the very end, and I ran out of time, the shadow banking system is a testament to the failure of previous regulations and of various ways to get around previous regulations, including the money market funds, back to Regulation Q and all of that. So the fact that we have such a complicated system because we've failed to regulate the system effectively before is a really poor excuse to not do what we need to do right now. Otherwise, we really do give up. So it's as if you're saying, I can't have laws against robbery because the robbers, go to the shadows and I only have flashlights, don't go there. My cops are in the lighted streets only. These are not, money market funds are not, it's an example, are not in any shadows. They're in front of our eyes. It's not shadow. It's just we fail to regulate them effectively. Small hedge funds, we don't need to regulate. So it's like the shadow banking system is this bugbear that, is supposed to be scared off. They'll go to the shadow. Sometimes they go to the shadow. It's a good thing, okay? As Adam said, it's fine. Let somebody else do it. They don't need to be regulated because they're, MF Global even, it's a different kind of problem, but it's not a systemic problem. So, it's just, we need more studies, and they'll go to the shadow. It's just one of those formulas for doing nothing. And the question is, what are we going to do? So we're going to wait for models till the next crisis. We're going to wait for appropriate living wills till the next crisis. That's where we are. So the various people wanting more models are basically saying, I'm standing at the edge of the cliff. I'm about to fall, but I'm standing here 2 inches from the edges, and until you give me the cost benefit of moving, 3 steps backwards, I'm not moving from here. I'm staying right here. So, it's just too bad.
Well, I don't think you listened to what I said. Did you hear me say that we don't want analysis paralysis and we need to act? And I said that, and now you're saying I didn't say that. So okay, let me respond. So I'm not going to repeat. No, that's enough. No. We're not going to have a dialogue here. Not had her time before. And I'm not going to repeat my entire speech. Okay. So I was very clear that we don't want analysis paralysis, but that doesn't mean that we don't want some analysis. Mm-hmm. I said it was very important to act, and we acted with Dodd-Frank. I said what we have is 5 years hence to try to analyze whether we have had unintended consequences, whether we have had capital move to appropriate levels, whether we've had liquidity move to appropriate levels. And so that's exactly the kind of thing that I think we need to be doing, and I think the assessment that Neil and others here will be doing is extremely, extremely important. Specifics on cocos, I don't mean to be defending cocos because I brought up the issue that they created a lot of uncertainty. I actually don't think that they are the solution to these things, so I'm very sympathetic on that because I don't think that I think one of the challenges is, and I think one of the things we saw during the crisis, is that you have a contract that's triggered, even if it's before the crisis, but as things are getting weaker, that can create more uncertainty. and people pull out. Because even if it's, because one is, I think right now the way the contracts are set up, there's uncertainty of exactly what will trigger them. But if they do start to be triggered, suddenly people get equity who had debt before, they might want to get rid of that. Suddenly people have much lower rated securities than they had from before. And so I think it works much better in theory than in practice, because I think in the midst of a crisis, or even as you're getting closer to a crisis, just triggering these things doesn't necessarily generate more confidence. So I'm very, very, very sympathetic to that. But I don't want to dismiss the shadow kinds of things, because it's not that that's just theoretical or just something that's that's crazy. It's something that we need to think about, because it's the way the world works. In the 1930s, we had, well, in the 20s and 30s, or actually for the history of the U.S., we had all these restrictions on bank branching. And so there was a way that developed around that. You could, which was correspondent banking. It wasn't formally shadow banking, but it was creating a fragility that we didn't fully understand. And so just by saying, well, we can push it out of the banks and then it won't be that bad out there, or we'll be able to see it, I think even more of a challenge, is not the most effective approach. So I think it's not that I'm saying don't do these things. I think what's interesting to see is, look at countries that have had moved their capital up more. Switzerland has moved their capital up more than other countries. See if there has been things pushed off to the shadows. It may not have been, but I think it's worthwhile to look at that. I'm not saying that we shouldn't have done any regulatory change because of something that might have happened. We had the reality of something very bad that happened. We needed to act. But that doesn't mean that 5 years later we shouldn't be doing more analysis, and that we shouldn't be considering those things seriously. And I think we have seen lots of unintended consequences from things being in the shadows, whether it's some of the challenges of money market mutual funds, some of the challenges in over-the-counter derivatives. Anat, you had mentioned some of the that people have now said, oh, well, if we just take things over the counter and put them onto centrally cleared platforms, everything will be fine. I agree with you that is a way to try to address one of the interconnectedness problems, but it could be creating the mother of all interconnectedness problems if it's not done carefully. But that doesn't mean that we shouldn't be thinking about that. We should be trying to do the cost benefit. We should try to see, have we gotten the institutions right?
Hi, so I wanted to ask a clarifying question. I think it makes perfect sense to call for cost-benefit analysis, but I think the question then becomes, when you say that, do you mean thinking about it analyzing what we should do next, or would you make it a legal requirement that was enforceable by courts? And the reason you bring up the sort of MetLife case, and this dovetails very much with the question of analysis paralysis, because in effect, oftentimes, there has been a trend towards courts using some of the difficulties with conducting effective cost-benefit analysis to effectively preclude agencies from acting. And this becomes a particular difficulty when, even in this room, of a lot of we were having difficulty saying, well, is there an externality to financial crises? And apparently there are conflicting studies out there about, well, maybe there are not. Maybe actually the crash would have occurred in much the same magnitude even if we hadn't have had the financial sort of crisis that started it all. So if we can't even agree in this room about what the costs of financial crises are and how much the financial crisis of 2008 exacerbated the downturn, there's obviously huge difficulties in quantifying the benefits. And if there are huge difficulties, we should try to do it. But should we try to make it any type of legal requirement, or is that an invitation for analysis paralysis?
Well, and these issues have come up at the Securities and Exchange Commission, which does have a requirement for the Office of Chief Economist to sign off that something passes a cost-benefit test. And so obviously there's been a lot of litigation that's been around that, and the SEC has lost a number of cases on that. So I think the key thing is to try to make sure that the judiciary understands the limits of this, to do something initially. So I think what's useful and what some of the cases have said is that they didn't consider just reasonable alternatives, and they didn't consider certain types of potential issues. I think what I would want is to say, what are the considerations that should be there? I don't think you have to have sort of the final analysis of this. The Financial Policy Committee at the Bank of England has an explicit requirement that they have to consider cost-benefit analysis in doing regulation. And I think they have a very good approach to it. So they have an analytical staff that looks at what the potential pluses and minuses. They don't come out with a definitive number that, it's going to be +3 or -3. But they've considered those things, and then they will consider them as time goes on. My preference would be that you do have an explicit discussion of that initially, and then in any major piece of legislation that at some point, let's say at 5 years, that there be a requirement to do a look back and see what have been the consequences of this. So I don't want to stop. I don't want to stop regulation from occurring just because we might not know what the consequences are. We're never fully going to know. But I think having at least to go through the exercise of asking that question, as the Financial Policy Committee does in the UK, and then I would add the piece that when you have the legislative change, you gather the data, whether it's for the Office of Financial Research or at the Fed or elsewhere, so that, my preference would be that it's public data so that academics, the public, anyone can try to do those kinds of assessments. Jim.
When you're talking about very large financial institutions in the U.S., you're talking about global financial markets. And when I go overseas and I start talking about too big to fail, everyone sort of goes and checks their iPhone. So they're not interested outside the U.S. They're not interested. I don't even think I've heard the words too big to fail outside of U.S. borders. So they're just not interested. They think it's just a normal way to operate, that the government would give a very large subsidy to their largest financial institutions. I think this is true in Japan and China as well, and certainly in Europe. So suppose we end too big to fail in the U.S. Are we gaining something in this global marketplace by doing this, or is it something that should be attacked on a global scale? Or how should I think about this? How should I think about this issue that other countries don't seem to care about this?
It is interesting because you would think in the UK, where they had intervened to take over a number of the major banks, and they really just have 4 banks that have a very, very significant fraction, and it's much higher than in the US, that this would be an issue. And I was just at the Bank of England last week, and I was talking about coming to this conference, and that doesn't really seem to be an issue that's there. And I think that is problematic because, in some sense, the original round of Basel was because of exactly this international concern. The Japanese banks were growing very rapidly. Now we think of Japan as not a strong economy, but 30 or 40 years ago, it was the China of the day, world's second largest economy, growing very rapidly, and their banks were growing rapidly and internationalizing rapidly, and they had thin capital cushions. And so we had some international regulations to try to, one of the motivations was to sort of slow the growth of the Japanese banks. That wasn't explicit, but I think if you were to talk to many of the people who were promoting this, that was one of the issues. So I do think that there need to be some international standards. But I think if a country like the U.S. wants to have standards beyond that, I don't think that's problematic. If you do something so that institutions can't compete internationally, to go so far that can then be problematic if then you're just getting foreign institutions that have lots of risks associated with them doing the activities domestically. We're trying to prevent that by saying, well, if you want to operate in a significant way, now you have to have a separately capitalized incorporated entity that is operating in the U.S. following U.S. rules. And so I think that's something that helps us. So even if we do have standards beyond others, that we will be somewhat, the competitive landscape will be somewhat protected. But I think that's why you need some international baselines. But I think if we feel we need to go beyond that, that is not going to prevent the U.S. from having a strong financial system.
To those who would like banks or large banks to be like public utilities, they must have a different recollection of history than I do. I still remember the warm, suffocating embrace of Ma Bell in the old days when all that every household was allowed to have was one black rotary phone. So that's one observation. An observation about the data. My own reading of the data is that financial crises do lead to more significant declines in aggregate economic activity than would occur otherwise. But I wanted to introduce again the idea that this is far from settled as a matter of data. And one good illustration of that is something you brought up. From 1929 to 1933, GDP per capita in the United States declined by 33%. GDP per capita in Canada declined by 40%. Canada did not have a financial crisis, and no, the volume of trade in Canada was just not big enough for reasonable models to generate purely through the trade multiplier the kinds of declines that they saw. So let that be another fair warning to those who think that the connection is absolute, it's unquestionable, it's there.
I think history is incredibly important, and this also gets back to a point that Anat raised. So you don't want to just say, well, we're not sure, we don't have any analogies. I think there are a lot of very useful historical analogies that can be that we can learn a lot from. Do you want to say that that's perfect? For sure not. But I think exactly as you're pointing out, it raises a question for those who make a very strong assertion that it's always got to be this way. And so when you do the analysis, you want to take those kinds of things into account. And I think history is extremely rich. One of the things that I've really been focusing on at the Office of Financial Supervision, the Office of Financial Research, is they're really trying to get data together, which I think is extremely valuable. But they have limited resources, and so you can either get lots and lots of current data and lots of different things, or you can try to extend your data sets to be longer. And I've really been emphasizing trying to get data sets to be longer because I think the example of the housing crisis that I gave, you can get this false sense of confidence. I mean, we had 50 or 60 years worth of data. Things were really well worked out in our risk models, but we were using the wrong data because that didn't apply when you have this kind of innovation. So you want to have longer time series because we're talking about infrequent events. Precisely because they're infrequent events, they're not going to happen a lot in the data, and so you can get a lot of benefits by looking over a longer time horizon. Gene, I think you had a. Okay.
Randy, I'm a big fan of what you've just said about study and the value of entities like the Minneapolis Fed. I'll say that in my remarks in terms of serious study. And the point you made about cocos, I think, is a marvelous example of when you sort of govern by hunch as opposed to actually having a study, because it may well be that these instruments become more destabilizing than stabilizing. We just don't know. I'm not one way or the other. It seems to me that, to Anat's point, that, okay, where's the action? That it would be useful for all of us, but particularly scholars like you, to put together a list of those things that ought to be studied that might lead to some betterment of what we have. Now, the one thing that strikes me in that regard that I would put as number one is the ALLL. That is, I think, in terms of studying, it's both old nostrums and new nostrums.
Would you explain?
The allowance for loan and lease losses. This is a tool that bank regulators used for a century. And it allowed for judgment in terms of how much money you put away for a crisis. The tool was really taken away by the accounting profession in about 1995. And so when we went into the crisis, the ALLL cushion was at a historic low given the size of the financial system. My own view, it's maybe just as wrong as everything else because, as I say, I'm for study, for going on the basis of hunch, is that this may be one of the richest areas of ability to sort of stabilize the system in the banking system, which is giving back to banks the ability to use their judgment to build up cushions during good times to be used during bad times. Now, the knock on that has always been that, oh my goodness, it's like the banker's piggy bank. I don't buy that because this is totally transparent to the public. Everybody knows what it is, how big it is, but again, I'm not here to advocate for that. It just sort of came to mind when you were making the point about cocos. But it seems to me getting a list of things that genuinely deserve a great deal of study and what their cost benefit, I think, would be very valuable. And I think the way you're heading is admirable and very impressive.
Great. I couldn't agree more. I think one of the things that would be extremely valuable, and one of the things perhaps that I'm putting a lot of burdens on Neil and all the staff members here, but in some sense coming up with the agenda. We're not going to be able to solve everything in the next and do all the studies. And as I said, we shouldn't stop from doing things just because we haven't gotten all the details right. But I think we've now had enough distance from the crisis. We've now had enough regulatory change in different countries that I think we're in a good position to ask exactly the kind of questions that you're asking. So let's go back and see, well, some of these are sort of very focused technical things. Some of them are the innovations, which, like the cocos, and try to understand. So let's try to understand what happened in January, February. Was it, and is there something that could be done to correct that? Because if it was just some uncertainty about how these contracts are going to be operated, if you could provide that uncertainty both on the supervisor's part and to the investors, then you may get a much better outcome than a worse outcome. It may be that you can't correct these, that this is something that works great in theory but will work poorly in practice. I don't prejudge that. I think it's worthwhile that we have tried to do these other things. But I think kind of coming up with the agenda, the questions that would be valuable to ask, then trying to give some sort of priority to those, because there are a zillion questions that can be asked. It's very hard to know what the priorities are, but sort of vet that through the system, vet that publicly, vet that with academics, and then they kind of work through these things. And I know you have a great visiting scholar program at Minneapolis Fed as well as many of the other Feds to encourage people to focus on these kinds of issues. I think that would be an extremely high. That would pass a cost-benefit test, I think. So I just wanted to say thank you very much for this. Sorry to have, we had some good questions, so we got the discussion a little bit longer, so you didn't get your dessert. Hopefully the sweets will come, certainly after me. And hopefully you will not conclude like my friends and former students in the markets that former Federal Reserve Governor Kroszner has said nothing. Thank you very much.
Randy, thank you very much.